Hello, everybody, and welcome to episode 12 of the Presidio Perspective. I know we got a few more people joining with us, but we'll go ahead and get started. We have a great guest for you today, Jordan Greenhouse. Many of you have seen him before at the Presidio client events, so he's joining me from Kane Anderson, and he's going to be on with me today. As always, we have a lot to cover with you. I'm going to go ahead and share my screen and go over our agenda for the day. And then I just want to do a reminder for everybody, go ahead and enter any questions or comments that you have in that Q&A section. I'm sure there's many questions out there daily. So whatever questions that you have for us, take the opportunity to ask Jordan or myself any questions you have regarding the economy, stock market, COVID, or what have you. We'll be happy to answer those at the end. Also, today we're going to have a survey we're going to be sending you. So we're wrapping up what I'll call season 1 of the Presidio Perspective. And we want to get your feedback when we come and launch season 2. So we've been doing this now for 12 weeks together, and we're very interested to get your thoughts and feedback on our weekly webcast. So I'm going to go ahead and share my screen. All right, so tonight's discussion, again, I'm going to go ahead and do a little overview of COVID-19 and the local reopening. And then our guest speaker today, who's going to be talking more about the economy and the stock market, Jordan has some prepared slides and remarks that he's going to share with you. And then also we're going to have time for a little Q&A for Jordan and myself to answer your questions here at the end. So also want to give everybody a heads up. So Retirement 101, which is our 2-day retirement course. Many of you have attended this 2-day course before. So we are launching our virtual course. First classes are starting June 23rd. So Tuesdays, 23rd and 30th, as well as Wednesdays, June 24th and July 1st. So if any of you would like a course refresher, it's going to be via Zoom. It's going to be 2 days, so very similar to the previous format, and it's going to be live. So me in studio, it's going to be a nice production, some new information. If it's been a couple years since you've taken the course, you might want a refresher. Also, if you know anybody that you'd like to refer this course to, you can have them sign up at retirement101.org. We'll be sending you information about that. And then we have a promo code RETIRE, and they're going to get the course for free. So the day 1 is free for everybody, and then you need a promo code for day 2. So anyway, want to give you a heads up. Expect more on that in the days and weeks ahead. So we ended last week's presentation talking about the 4 things that are really affecting the stock market. And here we have kind of once again what seems to be a giant disconnect to what's happening in the world that we see and what's going on Wall Street. You know, we've seen protests and burning down of buildings and a lot of social injustice, social unrest, and American citizens responding to that. Which has created a lot of fear and anxiety out there, and Wall Street seems to not care. And, you know, so again, you know, when we're looking at these companies that are trading publicly, they're looking at, you know, what are the things and events that are going to occur over the next 5, 10, 15 years that can materially impact how much money these companies are going to make. So far as of today, what you're seeing out there seems to be a temporary issue as far as Wall Street is concerned. And so they're looking still at these 4 things. And what we're looking at, again, the headwinds or tailwinds of 2020, which continue to be, you know, how this is how COVID-19 is playing out as far as a potential second or third wave. And this is going to have, you know, a pretty dramatic impact. And it's either going to come or not. If it doesn't come, you would anticipate that the market is going to look very favorably on that, right? I don't think I'm alone, or that you're alone in being concerned about a potential second or third wave of this disease. And I believe that we're going to get more information on this topic in the coming days ahead. I mean, we have had a lot of protests without social distancing and measures personal protection equipment, all the things that need to keep us safe. And if we have this rampant contagious disease, we should see a very significant uptick in cases in those cities and areas where you've seen those large group gatherings. So I believe the market and us, we're going to get that information in the coming days and weeks ahead. That'll kind of be another piece of information that we didn't have just a week ago. So this is the type of information as we look forward, new information turning unknowns into knowns is what the market is reacting to. So this is still a major headwind or a tailwind, depending on what happens with that second wave. You have seen more and more kind of in the headlines, the tensions between the United States and China, both politically as the governments clash, but also economically. And what I've told you before, and what I'll continue to say, is this is something we will likely talk about for the rest of our lives, certainly for the rest of my career. China has emerged as a global economic superpower. It is continuing to rise. So this is something that I think we are going to be talking about for a long time to come. So U.S. and China relations are something that is going to dramatically impact our economies and stock market. We are still dealing with massive unemployment. We did get numbers, at least the private numbers have come in from ADP, which we're looking dire, but not as dire as maybe expected. And I think we get the actual unemployment payroll numbers this Friday. And so we might, again, if the market is preparing for very, very, very bad news and we just get very bad news, the market will react favorably to that information. And of course, we can't forget this is an election year. And so, it's amazing. I mean, I remember the last election, I think I was saying this last week, and just how the news cycle was just dominated. Of course, you had the emergence of Donald Trump, which was captivating, to say the least. But here in an election year, we've talked about a lot of other, I guess, more pressing issues. So we'll see. We still have this to deal with. So those are still the four major themes of what's going on. We have gotten questions from clients, and those are concerned with the social unrest and injustice, that's happening in our country right now. I'll just say that, my take on it is that, the United States is still a very special place, and we are very fortunate to be here in this time. I mean, this is the wealthiest civilization that has ever existed. And myself and many of you have been fortunate that through our hard work and our abilities have been able to create a nice life for ourselves with a lot of hard work and defining and building our abilities. And I think about for myself personally that my hard work and my abilities in most places in the world and most times in the history of our existence wouldn't have mattered. And what makes this country so great and special is that they matter, and that we can really thrive and succeed in this country, which is something that's really special. And there's a lot of work to do. And I just think of, times in my life that, when I've experienced a lot of personal growth, professional growth, it wasn't through the easy times. If I think about the strengthening and growth in my marriage, and many of you can probably share this, it wasn't during the rosy days that my marriage got stronger. It was actually usually born out of some conflict. And certainly the same thing you can say for businesses and professionals. So, what's happening out there to me looks like what growth should look like. So that's my thought. I wanted to say something on what's going on in there. We didn't have any prepared remarks about the current unrest that's happening right now, but I just wanted to say that thought, that there's loud voices, sounding off right now, and we should listen. And as we're listening, and experiencing our emotions of what's going on, that's to me what growth hopefully looks like and sounds like in the early stages. switching back to the contagion that we're dealing with here with COVID in the United States. The cases still today are 1.8 million now in the US, total cases. The death toll from last week to this week has not climbed significantly, so that's some good news. 622,000 reported recoveries. So as we see, this is a chart of the case fatality rate of ongoing COVID pandemic. And so you can see that over the last month, we have been declining in the fatality rate. And again, like I said last week, we expect this to continue to decline as we get more of those, what are still being called active cases, hopefully get reported as recoveries. Here locally in San Diego, I think this is the first time in about, 7 weeks that we haven't added 1,000 positive cases. So this was a little over 7,000. We've added about, I believe, 500 new cases in San Diego. So this is the total caseload. So that growth rate is slowing down. Same thing with Orange County cases. Little uptick actually in Orange County over the last week. So they're approaching 6,800 there. Look, on the local reopening, you might have experienced some of this personally, but I know that this week, I believe it was Tuesday here in San Diego at least, that beaches were now open. So you can bring your umbrella and your towel, and most parking lots are still closed, but there's some normalcy kind of returning to our worlds and our local economies and ways of life. Some of you might be experiencing that. Salons have started to open. I got went to the dentist office this morning. So finally got to get into my dentist, and I had to send a text message from the car to let them know I was there, approach with a mask, have my temperature taken, and I was able to get my cleaning. So, we're starting to see these local businesses reopen, although not in the same capacity as they were before, but we'll see how that plays out. More and more dine-in restaurants continue to open as well. Looks like gyms are also starting to reopen, so they have their list of rules and requirements. So those of you waiting to get back to the gym, I know that I had all these plans of this really rigorous workout routine that I was going to do during this COVID stay-at-home order, and didn't get done. So I'm not venturing to the gym just yet, but I'm watching and looking forward to making a return. So certainly they're looking at fewer people, and this really depends on the local gym that you have, but at most it's expected to be at a 50% capacity to what they had before. So many of them are going to impose reservations and those kinds of things. So, but again, we're kind of still continuing to make progress and really light speed compared to what we were anticipating on this 4-stage reopening of California. And so, I think there's been, that comes from positive news coming out of the medical community, of course, a tick down in the rate of contagion, and businesses have also been in major need and clamoring for the ability to reopen. And we've been able to impose different rules that, kind of have allowed that to happen. So there's certainly some weird masks and things I was seeing that the dentist was using. They're using a ventilator, mask that they had going on. It looked like I was in a World War I movie or something like that. But yeah, all for our safety. We're still falling far short of our goal to fully reopen the economy. So again, we need to have, over the last 14 days, less than 25 new cases per 100,000 residents. And so over the last 2 weeks, most of these have been higher for all of these different counties here in California. So versus last week, Orange County saw a slight uptick, so did LA. Riverside had a pretty significant one. San Diego went down a little bit. They're at 52 or 53. They're down to 49.9. So we're still not quite there to being able to fully reopen this economy. So anyway, we'll continue to share this information with you. I know that this is really important to us. And, I kind of reserve my comments about the economy and the stock market till after we get to speak to our guest speaker. So Jordan, are you with us here today?
I am. Good afternoon, Dustin. Can you hear me?
I can. Good to have you. See that you're reporting from the executive suite there of the office.
New office space, exactly.
Yeah, perfect. All right. So Jordan is here from Kane Anderson Redneck, and he's going to go a little bit over about their firm and what they do and what they're looking at. So Kane Anderson helps work with Presidio in managing small and mid cap accounts for our client portfolios, so both domestically and abroad. So looking at small and mid-sized companies. So not what we're hearing about all the time, certainly, which is I think why they like that space so much, is it is what is less talked about. And certainly not what we see when we look about movements in the stock market, when you're talking about the S&P 500 and the Dow Jones, and really what we've joked about in the past couple of weeks, it's really been the S&P 5. So what's happening in the rest of the stock market? And so Jordan's kind of here to kind of shed some light on that with a little bit of a review. So Jordan, I'll try to man the keyboard as best I can, and I'll let you take it from there.
Perfect. And Dustin, as always, thanks to you and the team for setting this up. And, I think first and foremost, it's always important to comment to everyone out there. I hope you're safe and sound during these unique times. And as Dustin alluded to, it looks like we're opening up a little bit more every day. So hopefully that trend continues. What I'll do is I'm not going to go through an entire presentation. I'll pull out a handful of slides. I like to make these conversations as interactive as possible, as Dustin alluded to. But let me start with just a little familiarity with our organization for those of you that may not know Kane Anderson. Real briefly, by way of background, we started essentially as a family office in Los Angeles, really funded and founded by John Anderson, hence Kane Anderson Rudnick. Mr. Anderson's really probably most well known as the benefactor of the UCLA Anderson School of Management. Really, the reason we share this with our investors is kind of twofold, though. Mr. Anderson firmly believed, like many very successful individuals, is his first tenet was avoiding any forms of permanent loss of capital. From an investment standpoint, the way we interpret that, or the way we look at it, is trying to play better defense during difficult markets. Certainly Q1 of 2020 qualifies as that, and really generating lower downside risk over full market cycles. I think the other component that starts to give you a little bit more of a lens of about how we think is Mr. Anderson really believed in taking much more of a business analyst approach than what we consider a common stock analyst approach. So he wanted to make sure if we were going to look at investing in a business, we understand the core components and differentiators of that business, management, etc., over a 3 to 5 to 10 year period, as opposed to worrying about the next 3 to 6 months. So if you look at our organization, actually as of now, we manage about 35 billion in assets under management. The lion's share of assets we manage kind of fall under the small to mid cap arena, with about 2.5 billion in the international small. But, as Dustin commented on before, we've really hung our hat as an organization, kind of going back to our founder, really looking at these more inefficient asset classes. We want to kind of dig through kind of what's out there and look at businesses that many people aren't paying attention to both uncover value and look at businesses that we think are potentially your blue chips of the future. So if you go to the next page, Dustin, what I'm going to start to do is try to differentiate a little bit about what we do. I'm going to take a little bit of time today to talk about kind of the current world we're in right now and how we're thinking about it, and kind of how it has always carried over to our investment philosophy. I'll also bring you a little bit up to speed about how we're thinking about things right now. But the first comment I'd make is this slide here is known as tenets of quality. One thing we've known for a long time is just about every money manager is going to sit back and say they buy high quality investments. So it's become a bit of a commoditized term. No one wants to say they buy bad businesses at the end of the day, and we understand that. I think what's important for everyone on the call to understand is our view on quality and how we define it, we think is quite differentiated. And again, with the views of trying to play better defense, taking a more high conviction position, you really need to have those quality attributes with an investment that you're making. So when people think about quality all of a sudden, they tend to think about quantitative measures. And what I mean by that is things like strong balance sheets, strong cash flow statements, strong income statements, kind of your core check the box areas to uncover what's a good business, what's a bad business. What I think is important to understand is for us, that's about where 10% of our time is spent. Literally 90+% of our time is spent on trying to identify those top two core boxes. So we do think management excellence is important. You know, if you look at our business at about 35 billion, we run concentrated portfolios, which I'll talk about briefly shortly, but we tend to have very high conviction stakes in these companies. And with the assets we manage, what you're going to find is it's very common for us to be a top 10, top 20 investor in those publicly traded companies. And why I think that's important is one, it provides great access to management. We're not activists. We're not telling them how to run their business. What we really want to do is understand if the core business is very strong and intact. If you look at those kind of three quantitative measures, we want to really understand, is management, how do they deploy that capital? Are they, very aggressive in regards to acquisitions, which tends to be a no-no for us? How are they looking at the business 5-10 years out? We're not the type of firm that worries about next quarter's earnings and invests based on that. I think the critical component to all of this, though, which is really when we start to look and feel different from our peers, is what defines a Kayne business in our mind is the top left box. So market control, Warren Buffett thinks of this as kind of a moat around the business. If we're going to make an investment in a company, irrespective of the sector it's in, we want to feel that there's some sort of market control that company has. Because what market control does is it provides pricing power, it provides barriers against competitive threats, it really provides some sort of defensible characteristics that are sustainable in some cases over full market cycles. So if you start thinking about it and bring it more to kind of where we are in the world today, one of the characteristics that we've always talked about, and I'll show you some of these numbers later, we've always emphasized the importance of lack of leverage on a corporate balance sheet. And I think the important way of thinking about that is for the better part of the last 3 or 4 years, we've been speaking to our investors, advisors that work with us, and really trying to tell them to pay a little bit more attention to debt on the balance sheet. And the reason we were saying that is up until really January, February of this year, going into the end of last year especially, we were in an environment when it seemed like inevitably rates were going to start to go up. The economy was improving, the market was very strong, and rates were at historical lows at the time. What people weren't paying attention to is a lot of businesses were levering up their balance sheet because cost of capital was so reasonable. And going back to just the end of last year, our concern was always, if you have a lot of leverage on their balance sheet, the minute rates start to rise and the cost of capital increases, your business might not be able to grow or keep up with that. All of a sudden you get to February of this year, which none of us, well, at least we could never have expected this pandemic outbreak. And what ended up happening was essentially just about every business, certain more than other, but almost every business to a degree went essentially offline. The one thing we couldn't have predicted is rates have actually dropped. There's absolutely no expectations of rates rising for the foreseeable future. So capital remains cheap. The thing that people have to recognize, though, is because across almost all sectors and all businesses, their revenue streams have been compromised substantially. We firmly believe, looking at it long term, this is an environment when, yes, it's not rates that are going to impact those businesses, but actual revenue growth and sales have completely been impaired. And even as the economy stabilizes, a lot of different businesses are going to be slower to come online across various industries. So we actually believe that you've accelerated some of our concerns related to debt on the balance sheet, if that makes sense. So when we start thinking about things right now, while the recovery, almost a V shape we've seen in April and May is very encouraging, we think as you look longer term and companies start to come out with earnings moving forward, you're going to realize that this is likely an environment where the strong, high quality businesses potentially get stronger, and then the weaker businesses potentially get weaker, and some at some point likely won't make it out of this. And I don't want to pick a particular sector. What I'd share with you is this is pretty much across every industry. If you've been heavily levered up and your growth trajectory is not attractive, it's going to be an environment where certain businesses potentially benefit longer term, but it's hard to make a broad statement about everything being created equally. And the concept of a rising tide lifts all boats longer term is a little bit harder for us to digest. The other comment I'd make for us, which I think is important, is you look at the first quarter, especially from the kind of mid-February peak through all of March when the maximum volatility was kicking in. What was refreshing for us is just about every one of our portfolios, especially domestically, outperformed by about 9 or 10%, in some cases a little bit more. The reason I bring that up is for us, it reinforced what we focus on, which is playing better defense. But more importantly, as opposed to trying to react and try to figure out what to do, it gave us the opportunity to kind of take a pause. We set up many, many meetings and conversations with management, because what you have to realize is those CEOs and CFOs were sitting at home just like me right now. So access to those teams was actually very efficient. We were spending our time trying to assess what that business looks like 18 months to 2 years from now. So when you think about it, what we really mean by quality and differentiated business goes across all sectors. To give you a sense of what we're probably not going to be doing is we're not looking at areas like energy, where they've had a lot of challenges, and try to figure out who we think is going to be the winner out of that space. We don't want the commodity exposure, nor have we ever. We're not trying to speculate on COVID vaccines and treatments. So we're not going to invest. We don't really invest in things like biotechs because of the binary risk. We're going to look at more core businesses across all industries and look for the opportunities there. The other comment I'd make about kind of the environment and what's been kind of successful as a backdrop for us is, yes, we have owned businesses that have quote unquote benefited from this environment, kind of the move to kind of, let's call it working from home, or more innovative technologies to kind of, whether it's consumer discretionary, to kind of make bricks and mortar businesses more efficient, technologies that have helped businesses kind of streamline and incorporate and continue to operate. So in kind of financial services technology, these have been great places to invest. Fortunately, we've had those positions for a long time. We're not the type of firm that owns a lot of banks per se because of the kind of leverage on the balance sheet. But when you look across our portfolios, we have benefited from some businesses that have been well positioned for the COVID situation. But I think as you come out of it, it's really about the strength of those businesses, which is making us realize, by and large, we continue to sit tight. We've made some adjustments to our different strategies on the margins, some trimming, some adding, but by and large, everything we've had has remained intact. We're taking tactical opportunities to make new positions, but this is not an environment where we believe wholesale changes should take place. So Dustin, if you go to the next slide, what I'd probably do is give you some characteristics for that, which I think really provide color on what I'm trying to emphasize right here. And I'm happy to kind of give some actual examples or think about it even more in detail about what we're seeing right now. But we really have always tried to kind of empower our investors to understand we're not trying to make macro speculations on where we think the market is going. You know, you look at the recovery we've been in right now, while it's been a great backdrop, hopefully a lot of your balance sheets look better, your financial statements look better coming through April and May. That's encouraging. But longer term, we really believe it's going to be about the businesses you own, not just blanket statements about the overall economy. So if everything I talked about with quality does run true, it has to show up in kind of the characteristics of the portfolio. And irrespective of the strategy we manage, these slides look very similar. So I'm not going to go through every number here, but I think the things that really matter that hopefully support what I've been talking about are, we're buying high quality, very durable, consistent earning businesses. So you look at the return on equity, essentially double that of the market. That's a theme that's always been true with us, irrespective of where we are in the economic cycle. That's something that's very important. The second characteristic I think is probably more important right now, even than it was at the end of last year. So our businesses tend to be self-sufficient, or they tend to be either no leverage or limited leverage. So they have a lot of flexibility with their balance sheet. So debt levels of 2 times versus just under 7.5 for the index. We know that our businesses are well positioned to ride through this environment. And then if you look at earnings variability, in a nutshell, the lower number, the better. So it's saying the lower number means your businesses have a more consistent earning stream than the respective index. What I tell you in this case, this is a small to mid cap strategy. You see 40.4. This earnings variance is actually lower than the S&P 500. So kind of the benchmark that everyone looks at, we're buying small to mid-sized businesses with a more consistent earning stream than that of the index. So I'll go through really 2 more slides and then I'll provide a little bit more commentary in the world right now. But if you go to the next slide, Dustin, this gives you a bit of our differentiators. What I'd say, I covered a lot of that here, but go to the next slide, because I think sometimes the visual representation of what we're trying to emphasize here is what really starts to run true. So we know that in this environment, the large cap index has kind of been the most resilient. What people need to realize is the resiliency has really been represented by about 5 or 6 stocks. I want to be careful to not say that's good or bad. It's just really important to recognize that as you go down market cap and markets become less efficient, especially in the small to mid cap space, we don't need to own the same types of stocks that the broader index does to actually participate in that. The other comment is if you look at the top dark green box or kind of dark bluish box, you see our gross returns and the risk. So you want to be on that top left. Top left means less risk. The higher you are, the greater returns. So you're actually seeing, even in a small to mid cap portfolio, we've had better returns, arguably, or kind of inline returns with the S&P 500 with similar risk. That to us is really what matters most to us. So when we look at the world, when we look at our portfolio, we are looking at those businesses. The other thing I'll tell you, because we're getting a lot of questions about this right now, and it might kind of open up some questions as well. I mentioned before, we're speaking to a lot of different executives of either businesses we own or businesses that we're looking at across all industries. I also mentioned that we are not reactionary. You know, we tend to run between 30 and 50 stock portfolios. In this case, this is a 30 stock portfolio. So what people don't expect is lower risk, but it's all about the quality of the business. But the reason I emphasize it is you have to realize in a diversified portfolio, we own businesses that are associated with areas that are right in the kind of crosshairs of the challenges right now. So we do own some businesses that have some consumer discretionary or retail exposure. We own businesses that might have aerospace and defense or airline exposure. So the reason I bring that up is those stocks have been hurt just like everything else. But when we speak to these companies, so we own 2 part suppliers in the aerospace and defense area. And to give you a sense of how we're thinking about this and the conversations we're having is, first of all, none of the businesses that we own across any of our portfolios have taken any of the PPP money. So they're well capitalized. That I think is an important point. The other comment I'd make, which I think is kind of crystallizes it, is when we speak to these really 2 companies in particular, what they've shared with us is a few things. One, they said their businesses, suffering like anyone else because they supply the parts for, the large build, whether it's the airlines, whether it's Boeing, et cetera. And that industry has been working at a very slow rate, really about 40% capacity. In cases like Boeing and Airbus, they're just they have not really been manufacturing again. So the reason I bring it up is they've been supported by the federal government in the form of bailout, which is, I guess, stabilizing those businesses. But when we look at the 2 companies we own, what they shared with us is a few things. One, they have absolutely no concerns about riding this out, even if there is a second outbreak. So they're not worried about getting through 2020 or 2021, even if all of a sudden the airlines take a lot longer to come back online. What they did share with us is 2 things. One, they said if you look at an environment like 08, 09 during the financial crisis, a lot of similar challenges faced the economy. Yes, that was more banking related, but you have to remember travel and other areas were dramatically impacted. And what they said to us is a few things. One, they rode through that environment without really a problem. They said what you also have to remember is because you're not taking any government support or bailout money, your businesses kind of drive their success on their own. So short term, the companies, along with everyone else that take the bailout money, kind of recover with the rest of the market. But longer term, it kind of creates a ceiling on those businesses. The companies we own, in some cases, they provide parts that are alternative to the OEMs. And what provides that competitive pressure or the competitive benefit to these companies is you're dealing with very sophisticated industries where these products are kind of designed into the manufacturing process. So one, you can't create a competitor in this space because the airlines are not worried about a new innovator in that space. They want proven, designed in products. The other thing is that many of these products are at a discount to the OEM. So as they kind of get back into the manufacturing process, they're looking for FAA certified, designed in products. And if they can find it at a discount, meeting all these certifications, it provides a nice backdrop. The last comment I'd make is when you spoke to these executives, they said it takes about 18 to 24 months from that point of recovery for all of a sudden things to stabilize. And all of a sudden they use that flexibility in their balance sheet to either make acquisitions or to do creative things. So what I'm trying to explain here is we've been very encouraged by the businesses we own and what management is saying. While this recovery, especially in the past couple of months, is reassuring for all of us and the market tends to be very forward-looking, we certainly believe it's going to be more about the businesses you own over the long term, especially moving forward, rather than just making a blanket statement about the markets. And the last comment really relating to kind of companies like this is we've been trying to spend our time looking at some of these challenged industries and triangulate to understand where we think the big benefactors are going to be, because we do think there's going to be a little bit of a, maybe it's an overused term, but a little bit of a new normal coming out of this. I don't want to be too dramatic because the more things change, they say the same. But on the margins, we definitely think that certain evolutions related to technology innovation, related to how businesses work coming out of this, will show signs for certain businesses to really participate and thrive moving forward. Let me pause there. I know I kind of provided a lot of different commentary, but Dustin, I'm going to turn it over to you for a minute, and I'm happy to go anywhere, but let me just turn it over to you for a minute before I go any further.
Yeah, good. Thank you. Way to leave us wanting more. Thanks, Jordan. So, yeah, I love Kane's view of trying to find, those value companies, and just really speaks to what you do as an investor and how, the noise that we see in the stock market, long term. I think I was sharing a conversation with you, like right in the middle of all of this, or the beginning, right? And you're talking to some of those managers or those executives, some of those companies that you own, that said, we're not even looking at this. Like this doesn't even impact our decisions right now. This is still temporary. So whether it's a quarter, 2 or 6, we're talking about 10 or 15 years of earnings. And this is what seems to us has been being so monumental to other businesses are opportunities, like you say, or kind of just a blip in the road. You did say at the end, though, that some of these companies, that have these strong balance sheets, and this is kind of what you look for a strong balance sheet for, is that they are able to capitalize on opportunities. One of those opportunities are, like you said, were acquisitions. That's what they're saying, but I know that doesn't fit the Kane model. So, if they're going into this as an opportunistic acquisition, is that immediately they got to get out of the portfolio, or is that something that you're going to work with them and make a decision there?
So first of all, I'm glad you picked that up, and it's a great question. I mean, we tend not to like serial acquirers, and what I mean by that, and there are a few exceptions. There's some very phenomenal management teams out there and across all different sectors that do a very effective job identifying kind of roll-up strategies to make their businesses stronger. So what we're trying to assess is, if they're making an acquisition, is this accretive to their core business? Does this potentially make them stronger and diversify their business? Also, obviously, is their price that they paid fair? One of the reasons we tend to speak to management is we do expect some acquisitions coming out of this. Again, 18, 24 months coming out of this. And the beauty of that is they're basically coming from a position of power. And if you look at the businesses, like I mentioned in the aerospace, when they've made these acquisitions, they've made their businesses stronger. One of the reasons I bring up acquisitions and why we tend not to be a fan of growth by acquisition, with some exceptions, obviously, is because you need to make sure, you have to remember, some businesses and some executives or CEOs are actually compensated by the more acquisitions they make, which to us is very counterintuitive, something logical. We want to make sure, one, what business they're buying, how this fits into their long-term model, and we also want to look at their past history in doing this. So this is actually an environment where we'd suspect, coming out of this, some of the companies we own will actually be able to make some of these kind of roll-ups to strengthen their business, to buy some of their more inferior competitors. It's very, very interesting to watch because, again, if you look at the last month and a half, the market's had a very strong recovery. It's also encouraging to see how well kind of the small cap space has done coming out of this, because it got hit so much harder, especially in February and March. But I think your point is well taken, and we're very, very cognizant of what acquisitions they may be making. This environment, like we saw in the financial crisis, lends itself to great companies potentially getting greater. But we're going to look at each acquisition they make, have calls with management, try to understand it. And if all of a sudden we can't wrap our head around the long-term benefit, I promise you we will step away and look for the next idea. But I think it's really important because a lot of people, I guess what I'd say is a lot of people early on were looking at this, especially during February and March, saying, oh, are your companies going to do a lot with this right now? And the answer is no. I mean, this is a challenging environment. Certain businesses are wearing through this environment better, but no one's really excluded from this. But what's more important to understand is the market, while it's forward-looking, the business impact is a delayed indicator. like right now, no one's really setting any guidance. No one's providing any expectations for earnings. So kind of all businesses are rising together in a sense, with some barrier exceptions. What we'd always tell.
I mean, there's a little bit of, I mean, when you look at the S&P 500, which so many of us follow, and probably those listening, at home, I mean, when we think of the stock market, you look at these major indices, and it hasn't been, a rising tide lifting all boats. It's really been, that S&P 5 that, if you look at the top 5 companies of the S&P, I think since the beginning of the year, they are up 8%. Whereas the other 495 are at a loss, right? And so you kind of, I mean, there's a big difference within that index. And so I think one of the things that we are considering and that we've talked about, and perhaps where, the space and where you play has potentially some more benefit to it, is that, there has been this kind of this leadership from just only a few, and there's really a need for more market leadership, and I think that's the question that the stock market has right now. You agree?
Yeah, I totally agree. I mean, it's tough because we understand why so many investors use the S&P 500 as kind of their de facto benchmark, and it's interesting because the rising tide has affected more of the mid to small cap arena than the large cap arena, where it's
right.
been, give or take 6 stocks, which make up, I want to say 60% of the performance. It's a mind-bending number. And it's been fine because it's worked. But at the end of the day, in the market, we're focused on these inefficiencies. The beauty of it is we don't need to follow the herd mentality. We've always liked that fact, okay? So when we look at things and we think about the world right now, there has been a little bit more of, broadly speaking, a lot of businesses have done better in the kind of small to mid cap space in April and May specifically because they got hit the hardest. But what I'd say is, and this is really where we think our view looks different. We talked about quality, we talk about, call it a 30 stock portfolio. What people have to remember is in any given industry, you can uncover, let's say, 6 or 7 good businesses that kind of fall into a similar bucket. Rather than owning 6 or 7 of those, we want to pick the one we think is the best business in that area. That one business, whether it's like the trucking industry, what do we think provides differentiation in an area where it seems commoditized, and what's their differentiation, which has proved to be a very, very big benefit for us. So at the end of the day, when we think about concentrated portfolios, the only way you're able to manage risk and run a more concentrated number of names is by trying to differentiate what you think that best of breed is. And in an environment like this, what we think will happen, if history's any example, that best of breed will, one, wear the difficult times a little bit better. But as the markets evolve and things kind of stabilize and normalize, that's when they tend to be able to put money to work, and people will look back and realize they actually took on market share during that challenging period. It's interesting. I just see some questions, so I could kind of tie it together.
Yeah, go ahead. You can, both of those are for you. So if you want to take them.
Yeah, I was going to say, I mean, I could probably tie some of the commentary here. Is that okay?
Yeah, please.
One of the questions here is, mentioned some of the holdings in the portfolio are harder hit sectors like consumer discretionary. How do we decide where and when those holdings kind of move into something better? So I'll give you 2 examples. I mentioned before, we don't do a lot in the energy space. We don't buy the drillers. The way we invest in energy tends to be through things like service providers. So we own some, technology businesses that provide mission critical software to the energy space as well as the chemical space. So that's an example. That type of business we think has an extremely strong market control. They tend to have very low capital intensity because it's basically, if you think about it, it's a technology business. It's not an infrastructure business. So that business we've held on to. We think it'll ride through this and come out stronger. The other business does core analysis in that space. That business also had, in our mind, a little bit more of a slightly levered balance sheet. And when speaking to management, we didn't like the fact of how their capital deployment was taking place. And the other reason I mention it is because we have more concerns about energy infrastructure moving forward. Forget the price of oil, but just some challenges going on out there and things like deep sea drilling and how that looks for the long term. So in one case, we held on to the business because we think the moat that exists around kind of the sophisticated technology which the energy companies and chemical companies will continue to use. But we decided to sell out of the business we thought had a less strong balance sheet, and more importantly, was much more reliant on energy infrastructure coming back online. So there is a bit of a give and take. Again, if you look across the board, the last area I'd mentioned, because it's a common one, consumer discretionary, we don't own a lot of bricks and mortar retailers. We do own one bricks and mortar retailer, which has done relatively well during this environment. They are a very unique business. They focus on overstock inventory, more like housewares. So people can think of it almost like a Ross Stores in clothing. This business is more on kind of the housewares or unique areas. It's more like a treasure hunt environment, but it's not like a dollar store. It tends to be higher quality. We had a long call with management during the pandemic, and two things I'd point out. One, a lot of their businesses are located geographically in the middle of the US. So even during the height of that pandemic, their offices or their stores remained open. So they didn't completely shut down. The other comment I'd make related to it, which we think is long-term, is you think about bricks and mortar retailers and the struggles that they've had. You have to realize that if you have massive pricing power in identifying overstocked inventory, they potentially have a very creative way to use that money to put to work to identify very discounted inventory of high quality in the space they play. So short term, yes, it's a challenge. Our conviction in the name remains extremely strong, but there's nothing really speculative about it. It's just they're well positioned coming out of it. So it's themes like this. In one case we sold, but in most cases they've been very encouraging conversations. And again, it's about the moat and less market risk, more about just fundamental risk of association with an industry.
Yeah, that's interesting. And I know we talked about that before. And I appreciate you in the last minute, me telling you that our compliance team doesn't want you to name names and use ticker symbols. And so we're both, dancing around that now. So you're doing a good job there. So thank you. But yeah, so, I mean, it is interesting to think of those stores that you go to that have discount name brands, right? That are probably from the prior season, right? That didn't get sold. And you think of what just happened with this shutdown of all the malls and retailers and how much, in their businesses, well, what can I buy these items for and then sell them at a discount to the consumer? And so it's not just about, is there a consumer that you can sell to? What you're talking about is, what do they have to buy those now for? And so there's potentially a big backlog of name brand items that are, will be from last season that they could capitalize on. Is that kind of what you're suggesting?
That's exactly right. And this is where it comes down to, you need a strong balance sheet with flexibility to take advantage of those. You also need a leadership position for these different businesses to want to come to you first to identify this inventory. Because while overstock is great, you need that pricing power and domination. Otherwise, you're going to fall into the mix with everyone else. So again, you think about that, and these companies can do well in expanding environments, in kind of thriving economies. They can do well in challenged economies. But coming out of this, with all of the dislocation in bricks and mortar, there should be a good deal of opportunity for businesses like this. But again, it's the right type of business. It's not just making a blanket statement. The other thing I'd mention, and Dustin, I'm sure we can have a little bit of a back and forth on this one, because you kind of mentioned a few things. We do have to realistically sit back and say, is there going to be some sort of disruption coming out of something like this? So, you look at certain things and you look at the conversation we're having right now, and certain obvious areas are going to be, one, you look at things like commercial real estate. And I'm not going to get too dramatic here because it's not a matter of that business or that environment's going to be shut down. But you do look at businesses like ours. We're based in LA. We've got about 100 private offices in our office in LA. For the past, 2.5 months, we've been 100% working remotely. We've been very efficient in that. And I think what we're realizing is, moving forward, we probably don't need 100 private offices if and when we renegotiate our office space. So there's an opportunity to kind of downsize, to create efficiencies, to have more of a work-life balance. You look across various industries, you see that in this area. You look at repurposing of things like malls, you look at things like doctor's offices and inefficiencies there. You're going to find that many, many different businesses are going to be impacted by this. It's going to be in some cases on the margins, but some are going to be hit a little bit harder. The other side of it is just conversations like this, like everyone's enamored. There's nothing wrong, good or bad. It's been a great business. But you also have to remember that this type of technology is probably going to be part of our lives moving forward. This has nothing to do with stock. I want to be very clear about that. It's irrelevant. What it really comes down to is you look at things, you look at kind of like digital signatures that affects all different types of businesses. And what you have to realize is these are probably evolutions that are going to certainly affect businesses like ours, that if you're well positioned and your business really has some sort of market control or differentiation, these types of disruptions and innovations are probably going to really take hold. You know, you look at the advancements in kind of the healthcare space. Now, again, we're not speculating on things like, you know, vaccines or treatments, but you have to sit back and say there's going to be some adoption rates for things like, you know, I mean, it's a business, but like a teledoc, or not saying people are going to stop doing it, but these innovations are going to be real. People are realizing I can adopt to this. And what we're trying to do is figure out selectively which businesses do we think are most well positioned. So it's kind of a little bit more of the disruption and innovation. We're probably going to be a little bit more conservative with how we look at it, but we'll certainly wholly admit that this is something that likely will look a little different 5, 10, 15 years from now.
Yeah, absolutely. And again, most of the audience has, you know, attended our Retirement 101 course that I teach. And one of those things I talk about is the 4 genetic defects of our financial DNA. And one of those is our inability to picture the world in the future as anything other than the world it is today, or sometimes in the past. But, you know, when we picture our own lives and we're trying to make decisions about what we want to do, it's impossible for us to picture what the world looks like 5 to 10 years from now. And what we can all pretty much surmise at this point is that it's completely different. You know, it's very different. And so we've been talking about these technologies for years of when they are going to take over, you know, and I've met with a lot of clients over the last couple of years that really love to have, you know, paper statements. And, you know, some of the things I say is I understand, but you are going to have to figure that out at some point in your life, and you can decide to do that at 60 or 80, but at some point, you know, you're going to need to, it's not going to be an option, you know? And so we kind of see these things, and it has been interesting with COVID and when we're forced to stay at home. I mean, how wonderful it's been that we've had these technologies that have allowed businesses to continue, like mine and yours, and your whole team working from home as mine has, and been pretty efficient and productive in doing that. And our clients have continued to experience a really high level of service and connectivity with us. And so these things are great. And yeah, there's just no way that they're going away. They're definitely here to stay. So it is, I was talking to Cheyenne on our team yesterday. You know, I think Elon Musk did another Joe Rogan interview recently. And so that's always interesting, you know, and he's talking about the neurotransmitter being injected in our brains and, you know, when's the timeline for that? And it's just, you know, it's wild, but timelines are really challenging, you know, when it comes to some of this stuff with technology, where you can look at it, you and I can have a discussion about, well, that's absolutely going to win. There's no question that that's what the future looks like, but knowing whether it's, you know, 10 or 40 years could be really challenging, you know, and so, and especially with commercial real estate and those kinds of things you start to think about.
Yeah, I mean, it's totally true. I mean, and what I'd emphasize, and it's kind of ties to the other question on the table here is, you know, from an investment standpoint, you know, we are always trying to not really look around the corner, but we're trying to understand where things are going. Really, are our businesses well positioned for that? We're getting a test of some innovation that's taking place right now. You know, fortunately, we've had some exposure to it, and some of it we have conviction to feel like it's going to continue. So evolution is going to occur. It's probably going to occur more rapidly than people expect. But we always try to temper that comment by saying, you know, don't bet on the wholesale changes happening overnight, like the Elon Musk comment. Look, he's definitely a visionary. He's brilliant, and certain things might happen. You know, autonomous driving at some point in the future, that's going to occur.
Right.
If you look at us, and the question was, you know, how long do we usually stay in once we select the stock? If you look at the best performing businesses we own, and some of these have been actually the best performing stocks across any asset class, they're stocks that we've owned in some cases 10, 12, 15 years. So nothing makes us happier than buying a business that's, you know, $1 to $3 billion and just watching it grow and evolve. And a lot of these businesses aren't the most exciting things to think about. But what you have to realize is that they provide a sustainable, differentiated approach, and they have consistent market share. One thing is a lot of the business we own are kind of either designed in or they're embedded into what makes that business operate. And the minute you're embedded into any business's operations or mission critical software, things like that, as long as these companies are well capitalized, evolve their technologies, what worked yesterday often works tomorrow as long as that evolution takes place. So to us, it's great to try to look around the corner, to be selective about it, but we're not trying to speculate what's going to happen 6 months from now. These potential changes that are taking place, we'd like to feel that 6 to 8 years from now, we continue to own those companies. So, when you ask for what our thesis is of the business we own, we're going to get pretty granular on our approach, but it really comes down to that market control and moat, which doesn't happen in 6 months.
Yeah, so, I've noticed that with the companies that you invest in, and this is probably more true with the small and mid cap space, but it's kind of the pickaxes and shovels mentality of the gold rush, where you're not trying to say what mine is going to yield the most gold. You're just going to say that a lot of people are going to go out and look for it. And those are the businesses, it seems, that you guys invest in.
Right. And it takes patience. Right now is the definition of patience. There's a temptation, especially during February and March, to look at the world and sit back and say everything is on sale. And we understood that mentality, but the reason we didn't do a lot is because for us, it was an opportunity to reinforce why we owned what we owned. We did have to isolate a few businesses and do a little bit more legwork on them to make sure we weren't missing something. But because most of our businesses acted how we wanted to, it just raised our conviction and let us make moves on the margins. It would have felt terrible if we had to make wholesale changes and reshuffle the entire deck. At the end of the day, great businesses should continue to be great businesses, take on more market share, which is what we'd assess will happen coming out of this. I'd say the only difference is a little bit of this innovation we talk about, especially kind of in the technology and healthcare space. We'll see some of that coming out. But again, they're businesses that make sense today, and we think will just continue to make sense in the future. Even though Musk might be right about the neurotransmitted implants, we'll see about that.
Yeah, right. So out of these headline risks that we have with, COVID, an election, unemployment, and U.S.-China relations, which one of those concerns you the most?
So, the election, there's nothing to say about it. We didn't make any changes before Trump got elected. We didn't make any changes based on his election and so on.
Well, I have a follow-up question, which is who's going to win. So if
I can tell you one of two.
Yeah.
So the answer is elections are going to be elections, and markets tend to react short term, but it tends to create a lot of noise. If a new administration comes in, the market's going to react one way or another, and a lot of it's rhetoric, and we're not going to react to that. And it's proven the right move, no matter which cycle you're talking about.
Yep.
The other two areas I'd say, when you think about a potential, reignition or kick out of the pandemic, that's why we own what we own. Because at the end of the day, we have no control over it. Science seems to feel that there's a possibility we have another outbreak. If that occurs, we're certainly testing it right now. There's no doubt about it. That makes us that much more confident in what we own, even though we really hope that does not occur. The last piece, I think, is one of the that I'd probably expand on is China-U.S. relations. There's a lot of tension right now coming from both sides. There's been a lot of tension for the past couple of years. It arguably escalated a little bit today by some travel restrictions. The comment I'd make is, selfishly, in the small and mid cap space, we're less exposed to it. Our businesses are not large global multinationals. Tariffs and trade wars don't tend to impact most of the businesses we own. They tend to drive their sales and revenues domestically. So it's noise. We're not blind to it, but we're not affected as much by currencies. We're not as affected as much by trade relations. We're not as reliant on those foreign companies. I'd say for us, and I hope for all of us, hopefully it's just noise right now, because I don't think the massive escalation in that place gets any of us anywhere. The next month or two, we should see a lot more activity in that area. Hopefully it's just banter. But the comment I'd make really is, selfishly in the space we play, we don't have much macro commentary other than it hasn't been an area of focus for us, because our businesses don't really play in that global multinational ring.
The other kind of headline that I haven't commented on is the Fed's balance sheet and how much it's expanded. And, it's pretty dramatic. There were just, for the quarters previously, there was some modest adjustments and you kind of saw a downward tick. You saw a spike up in September, right? We needed to provide some liquidity to the fixed income markets. And then it just kind of doubled from there and ballooned obviously with this. So to me, that seems like a perfect recipe for rising inflation and interest rates. Is that something you're concerned about? And obviously looking at the low debt levels in your companies, that could be, good or bad things. But, is that something that you guys are watching and think that's a real possibility on the other side of this?
So at some point, it feels like it's got to be inevitable, if that makes sense. It's a global experiment. It's not just a U.S. experiment. I almost reversed what I just said. It felt like a global experiment ex-U.S. for a long time, where you had all these different countries. Japan is kind of the poster child for this, of basically just running their balance sheets indefinitely, which is not really changing anytime soon. What happened here is all of a sudden, we became the lender of last resort. Our balance sheet expansion has gone on to ways that I'll speak for myself, no one ever could have expected. The market does receive it well because it makes companies a little bit more stay afloat for a lot longer. But does it lead to inflation at a certain point? You'd have to speculate it does. It's just a matter of one, timing. This has proven to be able to go on a lot longer than people expected. And if you look at Japan, it's a great example of it.
Yeah.
The only comment I'd make, and I'm going to sound like a broken record, but I think it's okay. From our mind, it's one of those things where debt doesn't matter until it does. And when all of a sudden debt becomes an issue because you're a highly levered balance sheet, and whether it's inflation or just the cost of capital going up, businesses by and large and in every industry are going to have trouble keeping up. So we think now more than ever, debt still needs to be a piece of the equation people need to focus on. As long as the economy remains strong, that's going to sound like a lot of noise or kind of reason for concern that doesn't exist. But we're certainly closer to that being an issue than we were 6 months ago. It's an experiment. You know what I mean? We said that in 2009, the market did quite well for the next 11 years. There were some kind of glitches along the way, but we've certainly doubled down this time. Hopefully we'll see stable growth. Hopefully businesses stabilize and look better coming out of this, and the consumer comes out stronger than maybe anticipated. But we really think, again, this is the biggest thing I'd say, and it's constantly repeated, but we firmly believe that it really comes down to owning the right businesses. Try not to be, it's easy to be bearish, but look what that's gotten investors over the last 6 or 7 years. You want to remain investors. Markets can be quite resilient, but it should matter a lot more about what you own moving forward, rather than just trying to paint a broad stroke about the overall economy. We are not the best macro commentary providers by design.
Right.
We think now more than ever, it's really going to be more at the micro business level, and rather than just trying to make broad strokes about things. But it is a bit of an experiment we're going through. There's no doubt about it.
Yeah, absolutely. Well, Jordan, so glad that you joined me today. Thank you for your time, as always, and insights. I love having you and talking to you. I always gain something from it, so really appreciate it. So everybody, we'll wrap up our episode. Wonderful. Ava, you're giving me a plug. Thank you. So can you repeat where to find Retirement Course? I can. Absolutely. So if you go to retirement101.org, and we will give you information in this in the coming days and weeks, retirement101.org is where you can sign up for our upcoming retirement course. So we'd like to send you an email in the coming days, of course, which you could forward to a friend. But we don't have capacity constraints for this one. I think on our marketing team, we kind of put together limited availability or something, which obviously isn't true if it's virtual, but I think that was just a little typo, but it still looks nice. But anyway, we're going to send that out. I'm really looking forward to it. It's going to be really well produced, as well as future episodes of this webcast. So again, retirement101.org is where you can find all the information about our upcoming retirement course. It's going to be a live video feed with me doing an instruction on the course. It's going to be very nice. And we're going to host it through Zoom. And then also we're going to be concluding our Presidio Perspective webcast, and it's going to be coming back a lot better than what you've been experiencing. So I'm looking forward to that. We've had 12 weeks now where we've had guest speakers. We've been in front of you during this whole pandemic, week after week, talking about what's going on. And we have a nice loyal following. We want to continue this with you, but we really are interested in your feedback. So as you log off of the presentation today, if you don't mind just taking 30 seconds, answering a few quick questions, we greatly value your feedback. So thank you everybody for attending another episode with us this evening on the Presidio Perspective. Look forward to talking to you personally in the coming days, weeks, and months ahead. Stay safe. Wish you all the best.